the issue we face in Canada is that CRA doesn't recognize an LLC as a flow-through entity like the IRS does. It's treated as a corporation for tax purposes in Canada. So in the US, you're being taxed on that income as a flow-through entity, but in Canada, you're being taxed on that entity as a foreign entity. So unfortunately, with that type of structure, you don't get the benefit of the foreign tax credit in Canada when you file your tax returns. So it's like a double taxation situation on on that rental profit and that eventually capital gain.
Okay.
And depending on your marginal tax bracket in Canada, you could be looking at paying 50, 60, even 70% at times on that profit in the US, which is not an ideal structure for you.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. And today we have the luck to have an expert accountant and tax specialist who can help us on cross-border investing. So hello, Elliot.
Hi, Axel. Thanks for the introduction. I appreciate it.
No problem. So before we jump into it, I just want to remind everyone, thank you for sharing this episode with a friend who you feel could benefit from this conversation, especially when it comes to tax and cross-border. There's a lot of questions when it comes to structures, the do's and the don'ts, and we're going to dive into it. So Elliot Milek, you're the president and founder of Can US Tax and Accounting. So thanks for joining the show.
Thanks for having me, Axel. Yeah. So as you mentioned, I'm the founder of the cross-border firm. We're located actually in Ottawa, and we just opened up an office in Florida a couple of years ago. So our firm specializes working with Canadians that invest in U.S. real estate. I mean, we have Canadians that invest primarily in Canada, but our niche area is Canadians buying U.S. property, whether it's through for personal use purposes, for vacation purposes, or for investment type purposes. So
Okay, so there's a lot to dive into here, and I just wanted to keep it narrow to bring our listeners a lot of value. One of the first basic questions that I have for you is that you've seen a lot of cases where people, as you just mentioned, they're Canadians, they maybe are a little bit further in life, they have a little bit more means, they want to buy a condo in Florida, they want to go spend 2-3 months a year, and then they want to rent it the rest of the time. Now, what are some of the biggest, I wouldn't say pitfalls, but top 3 things that people should think about when setting up that kind of structure?
Sure. So the first is, when I have these type of initial calls with individuals or potential investors, I like to gauge kind of what their long-term goals are. Is this going to be kind of a property that they want to buy, that they want to rent out, when they're not using it, or are they looking to buy multiple properties, are looking to buy in multiple states? So these are types of questions that I typically ask. Okay. And when I get answers to those types of questions, the first thing we talk about is typically how to structure it. Okay. For a lot of people, if they're buying just one property, they want to use it, for 6 months out of the year in Florida and rent it out for the remainder of the 6 months when they're not there. We need to determine what's the appropriate structure. So if you can buy it through a corporation, you can buy it through a partnership, you can buy property in the US through your personal name. Obviously, when you're incorporating, it comes with additional legal costs, additional, tax compliance costs that need to be factored in. But for a lot of people, buying it in their personal name is usually the most efficient way of doing it. It's the cheapest option there. As long as you get sufficient insurance, that's the second topic that we talk about. We do own an insurance company as well in Florida. So if you are looking to buy Florida property, we can insure that, and we can work with our team here in Florida to insure that property. So that's kind of the second issue that we talk about.
Okay.
And the third, I would say, is also the financing, because in Canada, when you're buying U.S. property, there is a lot of hurdles that you need to encounter as a Canadian getting financing. We do have a team. We will refer people to lenders in Toronto and in Ottawa and Montreal that work with Canadians buying U.S. property. If you're getting U.S. financing, we work with the U.S. banks to determine what type of structure they want to, or they're willing to lend on, essentially.
Mhm.
So those are the three main things that we talk about. So one is the tax, obviously the second is the insurance, and then third is the financing. And we put it all together based on your goals.
Yeah.
So, if you're buying one property that you want to use for half the year because you want to spend years and to rent out, a lot of times the U.S. bank is not going to lend to you on one small property through through your personal name. But you can go to an RBC or a TD Bank in Canada, and they will lend to you on that vacation property. But essentially, you'd have to buy it in your personal name. So they have different requirements than a U.S. bank would. So we figure out what your long-term goals are, what your plans are, and then we put those three fashions together, to put something in place for you.
Okay. Okay. And then that automatically made me think of, because I've heard that from people to say, oh, if you're going to go to the US, it's fine. Just set up an LLC and then just go from there. And I know that I've heard horror stories. And so can you kind of demystify for us what the LLC is and why it may not be such a good way to go about it for Canadians?
Yeah, so that's a great question, and I get that a lot. I get that a lot from people who use U.S. CPAs.
Yeah.
Nice way of saying it. So that's a generic structure that U.S. citizens use for buying rental property or passive investments, and it's actually a great strategy if you're in the U.S. But unfortunately, the issue we face in Canada is that CRA doesn't recognize an LLC as a flow-through entity like the IRS does. It's treated as a corporation for tax purposes in Canada. So in the US, you're being taxed on that income as a flow-through entity, but in Canada, you're being taxed on that entity as a foreign entity. So unfortunately, with that type of structure, you don't get the benefit of the foreign tax credit in Canada when you file your tax returns.
Mhm.
So which is like a double taxation situation on on that rental profit and that eventually capital gain.
Okay.
And depending on your marginal tax bracket in Canada, you could be looking at paying 50, 60, even 70% at times on that profit in the US, which is not an ideal structure for you.
No.
It does also create other complications. There are T1134 filings that need to be done in Canada for that foreign corporation now. So essentially, it comes with $12,000 penalties if they're late and not filed correctly. So they can be pretty extensive. I encountered a client a couple of weeks ago actually whose US CPA didn't advise him of the US or Canadian implications, and he got assessed a $12,000 penalty, and now we're working on getting out of it.
Yeah.
So yeah, needless to say, it's ideal to have somebody that understands both sides of the border if you are a Canadian. But unfortunately, we see a lot of Canadians going to the CPA and trying to get a Canadian CPA to do their Canadian tax returns, and unfortunately, there's always that mismatch between working with two different people, and there's always those hurdles with working with two different people. So ideally, it's always nice to have that one person to kind of go to.
Yeah.
But yeah,
And,
so those issues we face pretty
and
regularly.
you've described it very well in terms of, for an American CPA who knows American taxes, it would make sense to go through an LLC, but you've just outlined the importance of someone who knows both. And it's not the case of the vast majority of American CPAs or even tax advisors when it comes to this. So just to make it clear, and I always like to use examples, like, let's say, could we kind of run a basic example? Let's say that property has generated 50,000 of rental, and you've done it in your own name. That I understand, you're going to be taxed in Canada on that additional income. Whereas if you would have done it through an LLC, then what would be the implications?
So great question. So for example, if we do it in a personal name, that Canadian individual would have to file a non-resident US tax return and pay tax on that $50,000 of US profit to the IRS first, and that whatever state they're in.
Okay.
So because the property is located in the US, that State Department and the IRS gets first taxing rights on that income. And then the way it works in Canada is because you're taxed on your worldwide income, not just the income you earn in Canada, but all over the world, you have to report that income as well from that Florida property on your Canadian tax return in Canadian dollars. Okay. And because they're at the exact same level, at the individual level, that's CRA allows for a foreign tax credit. So if you paid $10,000 of tax on that rental profit to the IRS, you get to claim $10,000 of credits to CRA.
Okay.
So that's where the tax advantages come using the Canada-US tax treaty by buying your personal name. So if you choose to do it through a U.S. corporation or through a U.S. LLC, you don't get that benefit of the foreign tax credit. Okay. So in the U.S., it's a flow through entity. You're probably reporting that rental income on your non-resident US tax return. Okay. And it's being reported at, and you're paying that tax at the individual level. Okay. And then in Canada, you're paying that tax at the corporate level because it's an LLC, it's a foreign corporation from CRA's perspective. And unfortunately, because it's not at the same level, one's at the corporate level, the other one's at the individual level, you don't get the benefit of the foreign tax credit in Canada. And that's where the double taxation lies. So you pay tax to the IRS and then you pay tax to CRA on the exact same income with no credit. So and that's, and if you're in the highest tax bracket in Canada, if you make over $200,000, you're paying 50% tax already on your income. So, you throw in an additional, 50%, 60% on the rental profit. It's not an ideal situation for you. So
no, and it kind of defeats the purpose of trying to find an optimal structure to exactly avoid this situation. And in your practice, do you have this situation frequently? Like how often do you have to, in quotation mark, like save Canadians from US taxes?
Yeah, so nice way of saying it. I come across it maybe once a month, something like this. They get advice from a US CPA or a US attorney. Unfortunately, they just don't take a whole approach or holistic approach to this person's situation. They take a very marginal approach to this property and how it impacts them in Canada. And unfortunately, it's not always advantageous of doing that. I get this a lot as well. I mean, I have Australians, Israelis, I have a lot of different clients coming to me from around the world. And, I inform them that, we're just not aware of how to structure you in your home country.
Yeah.
I work with people who, in Dubai as well, who have no taxes there. I can tell them, there's no tax implication on your side of the border. But we do still have to file a return in Canada, or not Canada, but United States to report the income there because the income is sourced to the United States. So, we got to have these types of conversations. Unfortunately, most people don't because they don't deal in the international world like we do. Mm-hmm. But yeah, I mean, it keeps us on our toes, unfortunately. And once we make people aware of the issues and some of the problems and more importantly, a lot of the penalties that could arise with some of these late filings or non-filings that can occur, it kind of opens their eyes essentially.
Yeah. And then everybody says, oh, I should have planned better at the beginning. And then they come and see you.
Yeah. I mean, that's kind of the issue too. I mean, they kind of jump 2 feet ahead, into a property or a syndication type deal or whatever, wholesale type deal. And they're not unsure about all the logistics when it comes to taxation and legality issues. So, but, yeah, I mean, things can be fixed, just so you know. I mean, there's no right or wrong answer to everything. We can adjust things, we can modify your current structure. So, as long as you're not, selling a 100-unit property and you're asking for advice, 5 days before closing.
Yeah. So actually, that's a perfect segue because some Canadians go and they just buy a condo in Florida, and some actually want to build a portfolio in the US, whether it's in Florida. I hear right now a lot about Cleveland. I've heard a lot about Nashville. I've heard a lot in Texas. So let's take a different angle for someone who has a little bit of capital here in Canada, and they want to go and buy multiple properties to create long-term income stream. What kind of overall structure would make sense for them?
Yeah, so when I have these types of conversations, who's looking to build a large portfolio, one of the first things I ask is, what do you do in Canada? What type of work you do, whether you're an employee, whether you're self-employed, a business owner. Do you own any corporations in Canada currently? Like, where's the money coming from to purchase the property, at least for the down payment portion? Are you getting outside investors? Are you using, money from your holding company? Is it coming from you guys initially? Possibly any stuff like that. So it gives me an idea of how they're going to be structuring this particular deal. So a lot of our clients, we work with a lot of syndicators in Canada, Ottawa and Toronto primarily, who develop 100-unit buildings. They get their funds from a lot of Canadian investors. So, we discuss how to structure that, whether they're going to be doing it as an equity component or whether they're going to be primarily a debt component. And we talk about the two issues there with respect to U.S. taxation, how that interest is going to be reported to the investors in Canada. If they're an equity investor, how are they going to be reporting that profit from that flip essentially for in Canada, and the taxation surrounding both those options. Mm-hmm. So these are kind of the issues we talk about. There's no one set rule that we typically follow. Again, a lot of it's going to be dependent on the actual project. A lot of it's going to be dependent on the investors and where they're from. Like I said, we work with a lot of international investors, not just Canadian as well. Okay. And more importantly, what's the investors' requirements? Like I said, do they want an equity component or do they want more of a debt component? And structuring it in a way that makes sense for them. But a lot of our clients use like a flow through type entity for CRA purposes, which is either a Canadian partnership or a US partnership. CRA recognizes those types of entities as flow through entities for both US and Canadian tax purposes. So you get that benefit of the foreign tax credit in Canada. So you're not double taxed on that income.
Yeah.
But again, like I said, every project's different, especially when you're dealing with, large multifamily type properties, multiple investors, millions of dollars. So it's really a one-off project to determine what's the best structure for that particular investment.
Yeah. And I just want to clarify for everybody who's listening, I'm aware of what's a flow through entity, but some people might not be. So can you just define that? Because we've used it a few times already.
Great question. And yeah, so a flow through entity is an entity that typically doesn't pay tax at the entity level. All the income flows up to the individual partners and the tax is paid at the partner level. Okay. So for example, like a US limited partnership, you maybe own a 100-unit building there. You have maybe 20 partners that put on $100,000 and each own 5% share into that partnership. So that entity would file a informational tax return to report the rental income, the value of the asset, all the expenses, and basically issue to each partner what's known as a K1, or basically a form that shows the share of your profit for that particular year. So then you have to, that individual would have to file a U.S. tax return to report that income or the proportionate share of the income to at their level. So there's really no tax to pay at the entity level. It flows up to the individual partners at the top. So
yeah, important not to get double taxed. No one likes that. And then you're doing this on a daily basis for, again, Canadians who want to invest in the US. You mentioned the first thing is to properly define objectives and what is their goal with all this. Yeah. If you had like 2 or 3 pieces of advice to share with everyone, what would it be?
That's a good question. So when I have a lot of these introduction calls, I get a lot of people who don't really know exactly what they want first and foremost. They're just kind of, they're asking a lot of people a bunch of questions, trying to get information. For first, I think you need to figure out what you want to do, like where you want to be, like what state you want to be in, what city you want to be in. You want to know how much capital you have to invest. So if you have $100,000, it's going to your target property is going to be significantly different. Who might have $1 million or somebody has 50,000. So you need to figure out what you want. Are you going to go long-term or short-term type rentals? So you got to figure out a market that will cater to whatever option you prefer. So typically these are the things that we need to determine first. Find your market, find the properties that satisfy your internal or your IRR, your rate of return essentially that you want to receive. And then once you know that, we can kind of structure you properly in that particular market for taxation, insurance, and obviously financing as well. But that's the biggest thing that I find. A lot of people are just unsure about where they want to be, what they want to do, help plan that out for them essentially.
Yeah. So what I take out of that is to have clarity and then educate themselves.
Exactly. And that's the tough part, especially when you're buying your first property, because there's so much information out there.
Yeah.
It's tough for sure. So like I said, the biggest thing is figure out how much capital you have. We can work on the financing after that, but if you have $100,000, you're not going to go out and buy a $10 million property, but you can go out and buy, $100,000 property. Can go buy a $200,000 4-unit building or a single family that makes sense, and then we'll structure you based on the particular property that you want to buy.
And then I'm just thinking from a geographical point of view. So you're based in Ottawa, and then you also have an office in Florida. With what you've seen with your clients and your knowledge, what are the states that make the most sense? And we keep talking about like owner friendly or tenant friendly and stuff like that. Let's talk about tax friendly and structure friendly, because it does have a big impact. So where, and I'm not saying like recommend some states in the US, but like where do you see it the easiest?
So the thing with buying US property as a Canadian is that you're always as a Canadian, as I mentioned previously, you're taxed on your worldwide income
Mhm.
based on Canadian tax rules. So you're always going to be subject to the higher Canadian tax rates, regardless of what state you're buying in. Okay. So what I typically tell individuals is figure out if you're buying long-term or short-term and find a market that makes sense. These days, typically the property taxes in more the Midwest, Alabama, Tennessee, Louisville, Kentucky, Missouri, those states have lower property taxes. So you probably get a better bang for your buck in those particular jurisdictions for long-term holds.
Mhm.
Okay. For short-term holds, obviously those markets may not be advantageous to individuals. So you want to look maybe further south, like to Texas, Arizona, Florida, Carolinas, where you might not, where there's a little bit more short-term friendly as well. The property tax is a little lower. But unfortunately, when it comes to taxes, is that as a Canadian, you're always going to pay tax based on Canadian tax rules, and that's kind of the disadvantage of living north of the border. But you look for, what I always say is look for the property that makes sense, that meets your rate of return that you're looking for.
Yeah.
Again, like the Midwest is a great place to be because you're going to meet your numbers. The insurance is low, property taxes is great, and those are low. You go to Florida, the insurance is high, the property taxes are high, but there's lots of immigrants going there for vacation and the short-term rentals are great. So that's why you really need a little more clarity on what you want to buy and what your focus is. So from a taxation side of things, you're not really going to benefit from the lower tax states as if you were living in the US. But at the very least, you can find places with lower property taxes, lower insurance, and that's going to certainly help your ROI at the end of the day. So.
Yeah, for sure. And that's in the end what investors are trying to maximize. Not only is it maybe once in a while to go and for vacation, but they want to maximize their return on investment on their invested capital. Super. So if listeners are interested and they want to learn more about you and your company and how you can help them, what's the best way to get in touch?
Absolutely. So you can reach out to me via email, phone. My phone is 613-581-2695, or my website is simply the best way, and just reach out to me there. That's can-ustax.com. Email address is Elliot Milek at can-ustax.com. But those are typically the easiest way to get a hold of me. My assistant can certainly set up a call. We do give 15-minute free consultations on the initial call. So we don't charge for that. So if you are looking to kind of expand your portfolio to the United States, we can certainly help guide you into the proper jurisdiction, to help you out with the structuring and the financing and also the insurance, assuming you're in Florida. So.
For sure. Okay, perfect. And we'll make sure to include your contact details in the show notes, as it'll be a good reference for people who want to reach out. Well, Elliot, thank you very much for sharing your wisdom today. It's always valuable to be able to have professionals like you explain their perspective. So thank you very much.
Thanks, Axel. It's great being here.
Okay, and for everybody listening, as Elliot mentioned, get educated, research your market before you do anything, because you're not scrambling 5 days before closing. On this note, thank you very much for listening, and I'll talk to you next week. Goodbye.